you can actually make it a zero risk. There are strategies where you make money if the market goes up, and you will not lose a penny even if market drops 50%. In the last couple of years, I've made more than $1 million just using these two strategies. If you want to make 20%, 40%, 50% return on annual basis, this can work very, very well.
Earlier this year, my guest shared how he can make 100% annually with his double calendar strategy. But he also explained that he only allocates 20% of his trading capital to high reward strategies like double calendars. Most, 80%, is reserved for options strategies with very low risk or no risk at all. Today, we will delve into his low risk strategies.
Hey, John, good to see you again.
So, give me the high level pitch of your 80/20 philosophy.
I follow a barbell strategy where I allocate 20% of my capital to high risk, high reward option strategies like double calendars, leaps, or any other strategies I'm working on. To allocate 80% of my capital to safe strategies where I want my capital to be protected. I want to have zero risk or very limited risk, and it is for the long term. But I wanted to have even lower risk than buying and holding S&P. So for example, with S&P, you typically make about 10% a year, but in a worst case scenario, it can have a drawdown of up to like minus 50%, like it did back in 2008, and 20 to 30% drawdowns occur every few years. So to protect my capital from that, I deploy a more sophisticated strategy which involves hedging, and that can give me higher return than average and S&P, something between 20 to 40% return a year with much lower drawdown, or in some case almost like zero drawdown.
And you explained this very briefly in the previous video, and we had many viewers asking us to bring you back to explain these low risk strategies. So that's what we will do today. But tell us first just a little bit about yourself.
I used to work in a fintech company on personal finance products. Back in 2022, I was able to leave my job and transition into full time options. Now I just focus on investing and trading and different option strategies to generate a high income for myself. And that's what I do now. And I also started a YouTube channel recently where I share some of my ideas and strategies.
Tell us a little bit more about why you chose this 80/20 philosophy. Why not spend more of your capital on the strategies that have proven to give very good results?
Yeah, so I also watch a lot of other YouTubers, and I've also seen experiences of other traders who have done well. But I've also seen experiences of traders who have lost a lot of money. There are traders who sell naked options. They might make 2 to 5% a month return, but once Trump tweets something and market drops, they lose half their portfolio. Now, I don't want to be in a situation like that because I worked really hard to build up my capital. So I want to make high return, but I want to make high risk adjusted returns. I don't want a lot of volatility. I don't want a lot of stress. I want it to be easy and stress free for me. Like, for example, last month I was traveling for most of the month, and I was in a different time zone, barely even looking at the market. And still, I was up like six figures in a month without having to watch charts all day long because I deployed these kind of low risk passive strategies.
I guess this philosophy also allows you to take higher risk with a 20% part of your capital.
Yeah, exactly. So, because I know that 80% of my capital is protected, I can take bigger swings with the 20% of the capital. So, with that, I am easily able to make well over 100% return. Like, for example, in one of my account where I just trade option strategies, I'm up about 65% year to date. And I started that account in just February. So, we are 5 months into that account and it's up 65%. But on my long term account where I deploy low risk strategies, that is also doing very well. But I am not going to be in a position where if market drops a lot, I will have absolutely no stress at all.
How safe is it possible to make an options strategy?
So you can actually make it a zero risk. There are strategies where you make money if the market goes up, and you will not lose a penny even if market drops 50%.
Soon we will have the first live stream here on Theta Profits. The topic is zero DT e-trading. I have three amazing guests lined up. It is the queen of zero DT, Tammy Chambliss,
Boo to all the naysayers out there. So
Dale Perriman, the Ironfly guy,
I've been told that I have nerves of steel.
and Mark Anderson, Zero Day Mark.
But I really think that everyone can do 25 to 30% a year.
All of them have long experience in day trading options, but they do it in different ways. They will tell you how they trade, but even more important, most of the time will be spent on your questions. So check out the link popping up on the screen and register now to secure your spot. Back to the interview.
So, Ravish, let's dig into your strategies. What is the first low risk strategy we are going to talk about?
The first strategy I'm going to share is a high reward, low risk strategy. In this strategy, I like to sell leaps covered calls. A lot of traders like to sell cash secured puts or covered call, but they choose weekly expiry or monthly expiry. The problem with that is you can make money if the stock goes up in a month, but in a month when the stock goes down, you can be in a big drawdown because you are trying to capture 2 to 5% return in a month, but you are taking 95% risk. So even if the stock drops 10-20% in a month, then you can be in a big hole and you will be holding the bag for a very long time and not making any money on that trade. What I like to do instead is, instead of doing that, I like to sell leaps covered call, which can be anywhere between 6 to 24-month expiry. I like to do it on stocks where I would like to make long term investments. I've done a lot of trades like this over the last few years and I've made a lot of profit. So I'm going to show you exactly how to do that.
So let's show an example here then.
So, for example, here we are looking at a trade on HIMS. HIMS is a high volatility stock. A lot of active options traders like to sell options on this because the IV is very high. And but if you are making a trade on HIMS, let's say you want to sell a covered call with 1 month expiry, you are going to get $355 credit at the money strike, which is $50 strike. But you are taking a risk of $4,380. Now, in this case, you can make profit if the stock goes up. You can make profit even if the stock goes down a little, but you don't really have a lot of protection. You have a protection of about 7.5%, but a stock like this can sometimes drop 5 to 10% just in one day. So if I want to make an investment in a trade like this, I can sell a leap covered call with at least 6 months expiry, ideally 1 month expiry. So let's see, if I were to sell an option on this for June 18th, 50 call, I can get almost $1,400 credit for it, which will bring my max loss and also the debit for this trade to about $3,350. Now, in this case, there is a lot of opportunity for me to make profit, and my risk is now very low. You can see here that if the stock goes up a little, I can make about 49% profit in 10 months. And if the stock stays the same, I can still make 41% profit. If the stock goes down, I can still make profit. In fact, I will still make money even if the stock drops by minus 29%, which is my break-even point. So as long as,
29%.
yeah, so my downside protection here is 29% on this stock.
How do you choose the underlyings for this trade?
So I will choose underlyings where I like to make long-term investment because I'm going with 6 to 12 months expiry in most cases. So I want to do it on stocks and ETFs where want to be a long-term holder. And I don't care if it drops 30%. Let's say if something big happens, if there is a big catalyst or a recession and the whole market drops 20-30%. At that point, I will just acquire the stock for $33, so which is going to be a much lower cost basis. And then if the market recovers from there again, then I can be up a lot. I have made these kind of trades on stocks like Nvidia, ETFs like Triple Q, or even leveraged ETFs like T Triple Q, big cap stocks like Apple, Microsoft, Tesla, Amazon, any kind of stock where I want to make a long term investment, which I am comfortable holding for the long term. I can make an investment like this. And so far, I've done hundreds of these trades and I have not lost a single one.
But is this to understand it's some kind of a leap wheel that where you start with a cash secured put as a leap and then later go to the call?
Yeah. And there are actually a lot of different possibilities that can happen in a trade like this. Now, for example, let's say I enter this trade today and something big happens with this stock, and this stock drops down to by 10, 20, or even 30%. In that case, Leap is going to lose most of its value, and I can close this trade, and I can close the covered call, and I can continue to hold the shares. Now, after that, if it recovers back to the current price, I will be up 50% on my trade.
Hmm.
So that is also one of the option. Or I can, if it does not recovers, then I can hold it for several more months. And at that point, when it comes to a point where I think I can sell another covered call at the same strike price, I can do it again and collect more premium. But most of the time, when market drops a lot like that, after that, it kind of hits the bottom, and then it starts to recover slowly, sometimes even faster than it dropped. Um, but but this gives you a lot of cushion and wiggle room, that your downside is protected by like 30%, sometimes even more. And the way I enter this kind of trade is not when the market is at all time high. I like to enter these trades on pullbacks or whenever there is a big drop, because at that time the IV goes up even higher. So the kind of profit we are seeing here gets even better, because in that scenario we can get like 30% return on large cap stocks like Apple, Microsoft, Google, and more than 50% return on high volatility stocks.
So I assume you put on some of these trades in April.
Yes, I put on a lot of these trades on April, and even though the projected profit for them was about 30 to 50% in 12 months, most of those have already hit their 80% of the profit target in just a couple of months.
And that's when you close them?
Yeah. So if it goes to 80% profit, if it goes to 80% of the max profit, I can close it there, and then I can have cash ready for the next opportunity.
How many of these trades and how many different underlyings do you have on at any time?
I typically like to keep my number of positions to a manageable level. So with these kind of trades, I would typically have about 10 or so tickers, but I can deploy them in large positions. I can do six figures per trade, and I can deploy it into 5 to 10 different underlyings. Now, with this kind of trade, my goal is to be set and forget.
Mm.
I do it in an account where I put on these trades and I don't even have to look at it for the next 6 to 12 months. And so it can be very passive. There's nothing to, once you put on this trade, there is nothing to be done.
And the general results of this strategy?
So the result is that when the market goes up, a trade like this can make 30 to 50% profit within just a few months. But if the market drops further, then it can present even better opportunities, because then we can take off the covered calls, reduce our cost basis, and just hold the shares. And when the market recovers, sooner or later, we are going to be back in big profits. I did trades like this back in 2022 on some trades, In 2022, the market kept going down all year long. So I was putting on new trades like this every month. After that, a lot of those covered calls went worthless. So I closed them. And then market started to recover in 2023. Now I'm up 200 to 500% on some of those positions in just a couple of years. But because I was using this strategy, it gave me confidence to deploy capital without stress, because I knew that, okay, if I'm making a trade like this, even if market drops another 10, 20, 30%, I'm going to be okay.
Very interesting. So your first strategy was selling leaps. Now let's move to your second low risk strategy, or even no risk strategy, if I understand it correctly. What is that?
So the second strategy is called collar, but I have a very different way of doing it, which can make it a zero risk or low risk depending on how you configure it. I will show you both the options and we'll dive into how it works.
So before we do that, can you explain to us what is a collar?
A collar is a strategy where you start with buying 100 shares of any underlying, it can be any stock or ETF, and then you are going to sell a covered call, and you use the premium collected from the covered call to buy a downside protection. So you will buy a put. That way, your trade becomes range bound, that you make profit if the stock goes up to your covered call strike, but your loss is protected up till your put strike. So if the stock goes down under your put strike, you're not going to lose any money.
So let's look at your example then.
So to build a collar, you start by buying 100 shares of stock. So let's say we are going to do it on this stock called HIMS. We can buy 100 shares for 47.50, and then we can sell a covered call at 55 strike, which will give us 229 credit. And then we can use that credit to buy downside protection for the same amount. So we will collect 229 credit for it, and then we can use this $229 to buy a protection for approximately the same amount, which will make our net debit for options close to zero. We are still going to pay 47.50 to buy 100 shares, but our option spread is now free. So in this case, now if the stock goes up, we make profit. But if the stock goes down, our loss is limited. But we can have asymmetric risk profile. So in this case, our max profit for 1 month expiry can be up to 16% on the upside, but on the downside, we have protection till 9.5%. So it gives us a asymmetric risk profile. Even though the chance of profit is 50%, there's a 50% chance if the stock can go up or down. But you now have asymmetric risk profile where you are risking about 10% to make 16% return.
And this is how you typically set it up?
This is how a basic collar works, but I do it in a very different way. What I like to do is take advantage of the price discrepancies in calls and puts for the long term. In most of the stocks, you will see that in the short term, the puts are usually more expensive than calls. But when you go out to the leaps, the calls are more expensive than puts. It's for two reasons. One, there is a interest rate component called rho, which is factored into the call prices. So you are getting an additional 4.5% return for covered calls instead of cash secured puts if you are doing it on leaps. And the second thing is, in the long term, the market prices a more upside risk than the downside risk. So, which is why calls are going to be more expensive than puts for the long term. So, I like to take advantage of that, which allows me to make this kind of trade completely risk free. So, in a long term trade, I can select a long term expiry like December 18th of next year, which is a little more than 12 months. And then I will buy at the money put, and I will have to pay $1470 for it. Now I need to recoup this $1470 by selling a covered call. So I can go slightly up to a point where I'm able to get similar amount. So in this case, it is going to be, let's say I sell at $55. So it will give this kind of a very lucrative risk profile where if the market goes up, I can make 20% profit. If it stays at the same point, I can make 3.5%. Even if it goes down, I will make 2.2%. There's like zero risk in this. I will make minimum $100, maximum $900, 100% chance of profit. And if the stock goes up, I make money. If the stock goes down, I will not lose a penny.
What type of underlyings do you do this on?
I do it on underlyings where I want to be a long term investor, but might have some fear or FOMO that what if it goes down, or is it even going to go up? Like, for example, I did this trade on NVIDIA when NVIDIA was at 350. There is a way to amplify our upside in this. I was able to make 100% profit on it. And then I did this trade on NVIDIA again when it was at 750, which gave me upside till 150. So this is a basic setup. Now we can play around with the strikes to optimize our risk profile. So let's say I'm willing to take some risk for this. So if I can go down to 42 strike, I'm willing to take 10% risk. That will give us more wiggle room to roll our covered call out. And then we can get it to a point where um, now we have 56% upside and 13% downside. So it is still a huge asymmetric risk. We can make like 4 times more profit than the risk involved. It's not going to work exactly the same on all underlyings because we are basically trying to capitalize on the discrepancies between put and call prices, and that can vary underlying to underlying. So we have to do a bit of research to find the best setup, but you can find this kind of setups on almost all the stocks. Higher volatility stocks can give you better opportunity. Now, if you are able to make a trade like this where you have just 10 to 12% downside with more than 50% upside, that is a huge asymmetric risk reward. And it can allow you to make a lot of profit. And the longer out you go in the timeline, the more lucrative setup you can make. So let's say if I go for December 27, and in this case, now I have more wiggle room to the upside, and I can roll it down, roll it up to 95 call strike. Now, in this case, even though my timeline is a little over 2 years, I can make 100% profit with just 16% risk. So in this kind of trade where it's set and forget, where I can make 100% profit in 2 years with very minimal risk, that is a very lucrative setup for me. And then there are more advanced strategies where I can add different spreads to it, make it even more lucrative, where I can have 10 to 20% downside, or sometimes even zero downside, and 5 to 10 times upside of the downside.
So these type of strategies you do for your 80% or
Yeah.
part of your portfolio. You keep this in a separate account that you don't check every day. Is that correct?
Yes. So these are basically set and forget for me. Like for every trade, I think of this like a real estate deal that, hey, I'm getting this deal on this asset where I can make 50% profit in 1 year. I just put it on and don't even look at it for the next several months.
The colors you also put on when there is when the market goes down.
Yeah, when the market goes down, I can also do it. You can do it whenever you buy any new stock. You can also do it on your existing stock. So let's say you bought stocks back in April and now we are up a lot in just a few months, and you see that there can be higher risk in the next few months. Then you can set up a collar like this, which will still give you more upside, but it is going to protect your downside. So it is a great hedging strategy as well.
What is the biggest disadvantage of this strategy?
So the disadvantage is if the market runs up a lot after you get into a trade like this, you will not be able to realize the full profit of that trade in a short time. So for example, let's say I have 50% upside in 1 year and the stock runs up 100%, my upside is capped to 50%. And furthermore, I will have to wait for at least several months to realize that upside, because if let's say if I make this trade today, and even if it runs up 50% in the next 3 months, my trade is actually going to be up only like 25% at that point because it ran up too fast. So it has to go higher for me to capitalize that profit, or wait until the at least 50% of the expiry timeline to realize most of that profit. But there are some advanced strategies that I use to make adjustments, or to roll, or to turn it into spreads, to make to improvise that and increase my profit even more.
What are your overall results of this 80% part of your trading portfolio?
So in the last couple of years, I've made more than $1 million just using these two strategies.
As compared to how big capital you have had into these strategies?
I started with about 400K.
Ravish, I don't quite get it. From 400K to 1 million in a couple of years doesn't quite make sense compared to the 30-40% we have been talking about.
Yeah, like for example, I showed you a couple of examples where I can make 50% return in a year with a simple setup. Now, there are more advanced variations of this strategy where I can make adjustments or make rules, which can allow me to improve my upside even more. So, in those scenarios, sometimes I can make 100% return in a year as well, like I've done on trades like NVIDIA.
Ravish, we have now been through two low risk strategies. How will you sum up what we have been through, and who would you say this approach or this way of trading is best suited for?
So this strategy is best suited for someone who does not want to take much risk. If you want to make higher risk adjusted return than S&P, and you want to be stress free, where you don't have to worry about what the market is doing, or you don't have to watch charts, then this strategy can work very well, because it can significantly outperform buy and hold S&P or Nasdaq with much lower risk than holding S&P. So this strategy is not for someone who is looking to day trade and turn $1,000 into $10,000 in a short period. But if you want to make 20%, 40%, 50% return on annual basis, this can work very, very well.
And which is still a very good return for most of us. What would be your 2 or 3 best tips to someone who want to go into this way of trading?
So if you want to do a strategy like this strategy is for people who want to be patient, who want it to be set and forget. So if you are going to watch what it is doing day to day, then you might feel that sometimes, hey, the stock has run up a lot and you actually behind, but it is going to catch up in due time. So you have to give it time to cook. Like I said, I look at every transaction like a deal that I'm making for 1 year, and that is how I look at it. I'm not going to look at it day after day or week after week. It has to be set and forget. That is how you can make the most out of it.
What would be good places to learn more about this way of trading?
I have a YouTube channel where I'm going to create a more in-depth video with more examples on the strategy.
And I will also recommend that you watch our previous interview with Ravish about his double calendar strategies. And we have, of course, a lot of other interviews about different strategies that you may learn a lot from. Ravish, thank you for coming back and sharing even more of your strategies.
Thank you, John. It was a pleasure.